Welcome to the deep dive. We're here to cut through the noise and, get straight to the insights that really matter. It feels like the world's changing faster than ever, doesn't it? You've got huge entertainment deals, AI breakthroughs, consumer habits shifting, even policy impacting our daily lives. It's a lot. So today we're diving into a whole stack of fresh reports. We want to give you a look at what's happening across tech, business, society, our goal. Pull out the key nuggets, get you informed quickly, maybe spark a few aha moments.
Exactly. The mission here is to connect these dots, the things that seem separate, and show you the underlying currents shaping what's next. We want to help you gain that knowledge quickly and thoroughly, but without that feeling of being overwhelmed. Think of it as your shortcut, to understanding what's really going on.
All right, let's get started. We'll kick off with the AI revolution, maybe some of its ripple effects. And first up, how are Americans really feeling about AI? There's a rare Ipsos poll with some pretty striking findings.
Yeah, it's fascinating, especially when you see the public's perception kind of bumping up against the economic reality right now. So this poll found, get this, 71% are concerned about AI permanently displacing workers.
71%. Wow. Even with the jobless rate being pretty low, is what, 4.2% in July?
Exactly. And then there's political chaos. A huge 77% worry about AI stirring things up there. Remember that AI-generated video of Obama being arrested that Trump posted? That's the kind of thing they're pointing to.
Right, I remember that. Definitely caused a stir.
And militarily. Nearly half, 48%, are against using AI for targeting space. Only 24% support it. Then there's the environment. 61% worry about how much electricity AI uses. I mean, Google's already making deals with utilities to cut data center power during surges.
That's interesting. The energy footprint.
And maybe the most surprising, 2/3 worry people might ditch human relationships for AI companions.
Whoa. Really? That high?
Yeah. And education. Views are split. About 36% think AI will help, 40% disagree. So lots of anxiety mixed with some uncertainty.
It is striking, isn't it? All this public apprehension, jobs, society, relationships even. And yet, the money just keeps pouring into AI, like Databricks. They just hit a valuation over $100 billion. That's massive, even in this hot market.
Oh, absolutely massive. Databricks just joined a very, very exclusive club. They raised over $1 billion in their latest funding round. That makes them only the fourth venture-backed company to cross the $100 billion mark.
Yeah.
After SpaceX, ByteDance, and OpenAI.
Just the fourth. Okay,
Yeah.
their last valuation was?
$62 billion. So yeah, a huge leap. They're projecting annualized revenue of $3.7 billion by July. That's 50% year-over-year growth.
How does that stack up against rivals? Like Snowflake?
Well, Snowflake's got a $65 billion market cap, $4.5 billion revenue, but slower growth, around 25%. The Databricks CEO, Ali Ghodsi, said investor interest really spiked after Figma's IPO, and they plan to use this cash for products clients can use with AI models.
This whole AI investment frenzy, it's not all just straightforward success stories, is it? I've been reading about this thing called the zombie startup phenomenon. What's that about? It sounds a bit ominous.
It is a bit tricky, yeah. It raises some real questions about how big tech is playing the game, especially with regulators watching M&A. So what you're seeing is companies like Meta, Google, Microsoft, Amazon, they're using a new playbook. Instead of buying companies outright, they're doing these high-priced talent grabs.
Talent grabs, so hiring key people.
Exactly. Hiring key people, founders, top researchers, and maybe signing big licensing deals for the tech. It lets them sidestep some of the usual regulatory hurdles from mergers. But the downside, the founders and top folks get huge payouts, but the original company can be left hollowed out. A zombie company with other employees, other investors, kind of left in limbo.
Ah, okay. So the shell remains, but the core talent is gone. Do we have examples?
Yeah, quite a few, actually. Take Windsurf. OpenAI talks fell through. Founders, top researchers, poached by Google in a massive $2.4 billion licensing deal. Reports said employees were left in tears. Windsurf's IP eventually got sold to Cognition for maybe $250 million.
Wow. That's rough.
Or Scale AI.
Sure.
Meta put in $14.3 billion for a 49% stake, hired the CEO. Scale later cut 14% of staff. They say they're alive and kicking, generated nearly $1 billion in revenue last year, but still. Inflection AI. Microsoft hired the co-founders, loads of staff, reportedly paid around $650 million to license tech and pay off investors. Inflection still exists, new CEO, focused on enterprise AI now.
Okay, so the company technically survives, but completely changed.
Right. Character.ai, Google's $2.7 billion licensing deal, hired the founders, lots of employees left at first. Now they focus on their consumer app, apparently of 20 million users. And Covariant, Amazon hired 3 co-founders. About a quarter of the staff got a non-exclusive license. There's even a whistleblower complaint alleging the deal was deliberately structured to dodge antitrust review.
So this is really a strategy to get around regulations, because the FTC has been pretty active blocking tech deals, right?
Exactly. The FTC has been active. And while the current administration might be slightly different, antitrust is still a big concern. Taking these minority stakes, doing licensing deals, it's a way to avoid the mandatory pre-merger reviews for large acquisitions.
Mm. Getting the talent and tech without the full M&A headache. But yeah, you wonder about the cost to those smaller companies and the people left behind. Does this just kick the can down the road on regulatory fights?
That's the tension, absolutely. It's a workaround for now, lets them move fast in the AI race, but you can bet the FTC is watching closely.
Okay. So now let's shift to the hardware. The actual chips powering all this AI, NVIDIA and Intel.
Right. NVIDIA's got a new chip coming for China.
Another one. Didn't they already make a specific China chip?
They did, the H20, after the 2023 export controls hit. But this new one, tentatively called the B30A, is based on their newer, more powerful Blackwell architecture. Samples expected next month, apparently.
And this comes after that deal about giving the U.S. government a cut.
Yeah, that's right. NVIDIA and AMD both agreed to give the U.S. government a 15% cut of their China sales.
Yeah.
It was a negotiation, down from Trump's initial 20% ask. That was the deal to let them resume selling certain chips after the U.S. halted advanced chip sales over security concerns.
Okay. And then there's Intel. They've got a unique government deal brewing too, right? Something about an equity stake.
Yeah, this is quite different from the usual grants. Commerce Secretary Howard Lutnick basically said the government must get an equity stake in Intel in return for GPS Act funding.
The GPS Act, that's the big push for domestic semiconductor manufacturing.
Exactly. So the idea is to convert the grant money into non-voting equity, basically owning a piece of Intel on behalf of the American people. Bloomberg reported the White House was talking about maybe a 10% stake.
Wow. How did the market react?
Intel's stock actually climbed nearly 7% on the news, which is interesting because it followed SoftBank taking a 2% stake for $2 billion recently. And it comes while Intel's been kind of slow on its big Ohio factories, the Silicon Heartland. Even with an $8 billion grant already, they've struggled a bit to catch the big AI wave compared to NVIDIA.
So the government becoming an investor, that's a pretty significant development. Okay, let's move from cutting-edge tech now. How are other industries adapting? Let's start with something closer to home for many. Fast food and coffee. Beverages seem to be huge right now.
Oh, they absolutely are. It's a major focus. Chains like McDonald's, Dunkin', Dutch Bros, Starbucks, they're all pouring money into new drinks to drive sales.
And why now? What's driving it?
It's largely Gen Z. They want customized cold beverages. The number of drinks offered by the top 500 chains, up over 9% in the last year. Cold drinks are leading that growth. And here's the interesting shift. The reason people buy drinks isn't just washing down food anymore. The top reason now is getting a pick-me-up. So the drink itself is the main draw.
Ah, so the beverage is the destination, not the add-on. Makes sense. What are some examples?
Well, Dunkin's Refreshers platform is hitting record highs, sales up 30% year over year. Their fall menus got like Sabrina Carpenter-themed flavors and a cereal and milk latte. They focus on unique flavors you can't easily make at home, plus speed. McDonald's. They're testing new drinks in 500 stores. Things like creamy vanilla cold brew, toasted vanilla frappe, even dirty sodas, strawberry watermelon refreshers, all aimed squarely at Gen Z. They see drinks as a big opportunity, more profitable than food.
Dirty sodas. Okay, I might need to look that one up. What about Starbucks and others?
Starbucks is adding protein cold foam, 15 grams of protein per drink. Part of their turnaround plan. They say satisfaction is up among younger customers. And Dutch Bros, their stock's up over 22% this year. Sales growth over 6%. They introduced protein milk earlier this year, plus other unique stuff. It's working for them.
But are there challenges? It can't all be smooth sailing.
Definitely challenges. Forecasts show overall beverage volume growth is only maybe 1% through 2029, pretty flat. And prices. 61% of consumers who watch prices say they're ordering less because things have gotten more expensive. So it's a battle for share, relying on innovation.
That's a really clear shift. But is it sustainable? Or just chasing Gen Z novelty? That's the billion-dollar question.
It really is. The customization, the unique experience, that seems pretty core to Gen Z. But yeah, the overall volume forecast, it suggests it's more about stealing share and keeping things fresh within a market that isn't really growing much overall.
Okay. Now, let's pivot completely. Real estate. Specifically, senior living. Sounds like there's a major mismatch brewing there.
A huge one. Demographics are really starting to bite. You've got over 4 million baby boomers turning 80 in the next 5 years. That means a massive surge in demand for senior living.
4 million turning 80. Okay, so demand is skyrocketing.
Skyrocketing. Occupancy rates are rising fast. Demand growth is projected at 28% over the next 5 years. That translates to needing 100,000 new beds every year through 2040.
100,000 beds a year. That's incredible. Is the supply keeping up?
Not even close. Annual inventory growth right now, below 1%, the lowest it's been since 2006. They're only projecting about 4,000 new units this year and next.
Wow. Less than 1% growth versus 28% demand growth. Why such a gap?
Main culprits are higher interest rates and development costs,
Mm-hmm.
which is much harder and more expensive to build right now. But this gap is creating big investment opportunities.
Okay, tell me about that.
Well, you have Ventas, a huge REIT, like $31 billion. They're betting big on this longevity economy, buying up existing properties below what it would cost to build new ones and seeing strong returns. And you see a broader shift in real estate investment.
Yeah.
Healthcare, senior living, they're becoming a bigger slice of the REIT pie compared to, say, office space.
Makes sense. What are the costs like for residents?
Well, Aegis Living, for example, reports average rents around $12,000 a month. Often, residents pay using the money from selling their homes. And Harrison Street, another big real estate firm, saw over 30% jump in operating income for their U.S. senior housing strategy last year. They're calling this the strongest entry point in 20 years. More seniors live in these places now than before COVID.
That's fascinating. This longevity economy, it's not just a demographic trend. It really shows how slow industries can be to adapt, even to predictable changes. What does that gap tell us?
It really highlights that inertia, doesn't it?
Yeah.
Even when you see a demographic wave coming for years, things like interest rates can just slam the brakes on the response. It shows how even predictable trends can turn into a crisis if the market isn't nimble.
Very true. Okay, let's transition now to how policy decisions are making waves. Health, finance. Let's start with that healthy returns report on the vaccine panel and RFK Jr.'s claims.
Right, this one touches on public trust in health panels. So HHS Secretary Robert F. Kennedy Jr. recently gutted a key government vaccine panel. The reason he gave: persistent conflicts of interest.
Okay, conflicts of interest. That sounds serious. But this report challenges that.
It does. New research from USC Schaefer Center, published in JAMA, found the opposite. Conflicts on the CDC's main vaccine committee, the ACIP, they were actually at historic lows for years. Specifically, the kind of conflict people worry most about personal income from vaccine makers that was virtually eliminated.
Virtually eliminated. So what were the conflict rates then?
Since 2016, they averaged about 6.2% for the CDC's ACP and only 1.9% for the FDA's similar committee. Way down from the early 2000s when ACIP hit like 43% in the year 2000. The most common conflict reported now: research support, which is often tied to having the necessary expertise, not necessarily personal financial gain.
So the data suggests a very different story. How critical is it for the public to have that clarity on the integrity of these panels, especially with all the debate around public health?
Oh, it's absolutely crucial. Transparency, factual reporting on potential conflicts. That's essential for people to make informed decisions and trust the recommendations.
Definitely. Okay, another area where policy and personal finance intersect: insurance. Especially when you have a baby. That's a huge life change, and insurance often gets pushed down the list, right?
It really does, but it's so important to get right. There are basically 7 key insurance things to think about when you welcome a baby.
7. Okay, let's break them down.
First, health insurance. You have to add the baby. Birth is a qualifying life event. They're covered automatically for the first 30 days on your policy, but you must officially add them within that window. For ACA Marketplace plans, you get 60 days. Medicaid babies, enrolled automatically for year 1.
Okay, health insurance first. Got it. What's next?
Second, life insurance. Suddenly becomes essential. Term life is affordable, maybe 15, 20, 18 a month for a $250,000 policy for a healthy 30-year-old. And remember, the caregiving spouse needs coverage too. Their work, paid or unpaid, is vital. Third, make sure you have enough life insurance. Your work policy, probably not sufficient, often just 1 year's salary. Rule of thumb is maybe 10 times your salary. Think about your lifestyle, education costs, spouse's needs. Look for guaranteed insurability. Writers lets you add more later without a new medical exam.
10 times salary. Okay, that's a good benchmark. Number 4.
Fourth, consider life insurance for the baby. Sounds odd maybe, but it can cover medical or funeral costs. More importantly, it guarantees they can get coverage later, even if they develop health issues. Children's whole life policies also build cash value, usually available 14 days after birth. No medical exam needed.
Interesting point on future insurability.
Fifth, Get disability insurance. Seriously, you're more likely to become disabled than die young. 1 in 4 20-somethings will be disabled before retirement. There's short-term, up to 6 months, and long-term can cover up to 70% of income for years, even your whole working life.
Disability insurance, often overlooked. Okay, sixth.
Sixth, review home and auto. Upgraded the house for a nursery. Might need more dwelling coverage on your homeowners. Bought a bigger, safer family car, like an SUV. Revisit your auto insurance. Bundling policies can save a lot and make offers up to 30%, for example. Oh, and car seats. Replace them after a moderate or severe crash. Insurance often covers that under collision or comprehensive.
Good tip on the car seat. And finally, seventh.
Seventh, look into umbrella insurance. It's an extra layer of liability protection above your home and auto limits. Covers legal fees, medical bills if something major happens. Travelers offers policies up to $5 million. And just to clarify on homeowners, the baby itself doesn't raise premiums, but buying new stuff needs contents coverage review. And later, things like pools or trampolines, those will increase rates.
That's a really thorough checklist. On the life insurance for the baby, for a family struggling with costs, that might seem like a luxury. What's the core argument for it beyond just final expenses?
That's a totally fair question. For many, the strongest argument beyond immediate costs is locking in that future insurability. If a child develops, say, diabetes or another condition early on, getting life insurance later can become really difficult or super expensive. A small policy at birth guarantees they can get coverage at a low rate no matter what happens with their health later. It's a long-term safety net.
Okay, that makes sense. Locking in future options. Got it. All right, staying sort of in the realm of daily life and planning, entertainment, big move by the creators of Stranger Things.
Yeah, the Duffer Brothers, Matt and Ross, they just signed a big exclusive 4-year deal with Paramount Skydance. This is for movies, TV, streaming projects.
Paramount Skydance, not Netflix. Their current deal ends soon.
Yeah, exactly. Their Netflix contract is up in April 2026. So this new deal kicks in then. Their company, Upside Down Pictures, will develop stuff across the Paramount world. They said they're excited about bringing bold, original films to the big screen, called it a lifelong dream.
But what about Stranger Things? And Netflix?
They're still involved with Netflix for a couple of projects already in the works. Something very bad is going to happen. And the Burrows. And they still plan to build out the Stranger Things franchise there. This deal fits into the bigger picture at Paramount, after their merger with Skydance. The new CEO, David Ellison, wants to invest heavily in high-quality storytelling and cutting-edge technology.
Interesting. These creators locking in deals years in advance across platforms. Okay, let's widen the lens again. Economics, global trade, big update on U.S. tariffs.
Yeah, significant expansion. The Trump administration broadened its 50% steel and aluminum tariffs, added over 400 more product categories.
400? Like what?
Things like fire extinguishers, machinery, auto parts, plastics, specialty chemicals. Really wide range. It's expected to hit at least $320 billion worth of imports based on this year's values.
$320 billion, wow. What are the potential impacts?
Well, economists are warning it could add to inflation, strain supply chains again, make things more expensive and harder to get. And connecting this to the bigger economic picture, S&P Global put out a note. They expect the government will get meaningful revenue from these tariffs.
Revenue? Okay.
And they think that revenue will generally offset weaker revenue from Trump's recent tax and spending cuts, the big, beautiful bill. That bill is projected to add $3.4 trillion to the deficit by 2034.
So tariffs potentially paying for tax cuts, essentially. But what about the U.S. credit rating? S&P had warnings there, too.
They did. They kept the U.S. rating at AA+ broach, but warned they could downgrade it in the next couple of years. If deficits get even higher, or if political issues undermine institutions or maybe undermine the Federal Reserve's independence, they worry that Canada could eventually threaten the dollar's status as the world's reserve currency.
So tariffs as a trade tool, a revenue tool, but with potential risks to inflation, supply chains, even the credit rating. Complex stuff. Okay, finally, let's wrap up with something, well, different. Robotics. And a unique competition. The World Humanoid Robot Games.
This is really a sign of things to come. And yeah, kind of wild to think about. The first ever World Humanoid Robot Games finished up in Beijing just a couple of days ago, August 17th. Had 280 teams, 16 countries. And these humanoid robots, they competed in dance battles, martial arts.
Paddles, seriously?
Seriously. Dance battles, martial arts, track and field 400 meters, 1,500 meters, long jump, and soccer. He had programmers like Guo Tong saying they envision robots replacing soccer stars like Cristiano Ronaldo by 2050. They claim robots have stronger joints and core strength.
Robots replacing Rollo. Okay. What else?
An Olympic boxer who was there noted that robots are easier to coach because, quote, humans are emotional.
Huh. Robots that don't get emotional after a bad call or a tough round. I can see the appeal for coaches. But, more seriously, what does that say about the role of human emotion in skilled professions as robots get better?
That's a brilliant question, isn't it? It really hints at a future where maybe the value shifts. Perhaps human creativity, empathy, emotional intelligence. That becomes even more valuable precisely because robots handle the pure physical or logical stuff so well.
Interesting perspective. Who did well at these games?
Chinese companies, like Unitree, they're seen as a rival to Tesla's Optimus robot, won a bunch of medals. And the Chinese government is clearly all in on this. They want humanoid robots to be a key industry, aiming for world-class status by 2027. They're already planning a second games next August. The robots also showed off job skills acting as clerks, factory workers, hotel staff, though apparently opening and closing doors was still a challenge for the housekeeping bots. So the games are a real testing ground.
Opening doors. The final frontier for robots. Okay, so we've covered a lot. AI anxiety and investment, industry shifts from coffee to senior living, policy impacts on health and finance, entertainment deals, tariffs, robot games. So what does this all mean for you listening right now, whether you're maybe welcoming a baby, thinking about your job, or just trying to keep up?
Well, if we zoom out, you really see this fascinating interplay, don't you?
Mm.
Technology racing ahead, consumer habits changing on a dime, and these big policy shifts sending ripples everywhere. These aren't just separate news items. They're all threads weaving together this larger picture of global change, and it's happening fast.
Yeah, and that's where it gets really compelling. I think you've got AI with its incredible promise, but also that real fear of displacement. You've got entertainment giants making huge strategic bets, industries scrambling to meet demographic needs like senior housing, new opportunities, new challenges popping up constantly.
Which really brings up a key question for everyone, I think. As technology keeps accelerating, as it keeps reshaping entire industries, how does your own approach need to adapt? You're planning for the future, your finances, your career path. How do you stay ahead or even just keep pace in such a dynamic world?
That's the question to chew on. Remember, staying informed isn't just about collecting facts. It's about seeing the connections, understanding the why behind it all. Keep digging, keep asking questions, and keep learning.